The saying, "the only certainties in life are death and taxes," is applicable to most people when it comes to taxes. But managing the complex world of taxes frequently means a distinct set of opportunities and regulations for the wealthy. Although all citizens are required to pay taxes, wealthy people can drastically reduce their tax obligations by using a variety of legal tactics and loopholes. This phenomenon, often referred to as tax avoidance, has been the focus of significant investigation and discussion, posing issues with equity, justice, and the effectiveness of tax laws across the globe. Knowing how the wealthy evade taxes helps to clarify the intricate relationship between wealth, power, and the tax code. The strategies used by the wealthy to lower their tax obligations, from complicated business structures to offshore accounts, offer a window into a world where regulatory complexity coexists with financial savvy. In this investigation, we explore the methods and tactics employed by the wealthy to manage the tax system, shedding light on the legal means of minimizing taxes as well as the moral issues that are associated with them. The wealthy frequently employ the following strategies to lower their tax obligations. 1. Tax havens and offshore accounts. Rich people use tax havens and offshore accounts as essential instruments to minimize their taxes. Rich people looking to avoid paying taxes are drawn to these jurisdictions because of their lax banking secrecy laws and lax tax legislation. High net worth individuals can benefit from favorable tax rates, which may be much lower or non-existent compared to their home nations, by depositing money into offshore bank accounts situated in tax havens. Furthermore, these jurisdictions guarantee the anonymity of account holders through a cloak of secrecy that makes it difficult for tax officials to track down assets and enforce compliance. Tax havens and offshore accounts are now integral parts of wealth management plans for the wealthy, allowing them to protect their assets and reduce their worldwide tax obligations thanks to a mix of favorable tax laws and strict privacy regulations. 2. Shell corporations and complicated business structures. High net worth individuals use sophisticated procedures such as shell corporations and complicated business structures to reduce their tax liabilities. These organizations act as middlemen for the transfer of assets and income across other jurisdictions, taking advantage of differences in tax rates and tax policy breaks. Rich people can obfuscate the underlying ownership of assets and revenue streams by creating complex networks of shell corporations and subsidiaries, which makes it challenging for tax authorities to efficiently trace and tax them. Moreover, these arrangements facilitate the calculated transfer of profits to countries with more advantageous tax policies, enabling the wealthy to reduce their overall tax liability. The capacity of the wealthy to maximize their tax tactics while staying within the law is made possible by the flexibility and adaptability of complex company arrangements, even in the face of legislative efforts to discourage aggressive tax avoidance through such arrangements. 3. Tax deductions and credits. A wealthy person's armory of key tools for reducing their tax responsibilities includes tax deductions and credits. Rich people deliberately use a variety of deductions, such as those for company expenditures, charitable contributions, mortgage interest payments, and investment losses, to lower their taxable income. The wealthy can successfully reduce their taxable income and, as a result, the amount of tax they owe the government by taking advantage of these deductions. Additionally, tax credits present greater chances to save taxes, especially for endeavors that advance societal welfare and economic expansion. Tax liabilities can be significantly decreased, for example, by credits for R&D expenses or investments in renewable energy projects. The wealthy can reduce their tax burden and encourage innovative charitable. 4. Capital gains and investment techniques. Wealthy people's tax planning efforts heavily rely on capital gains and investment techniques. Rich people carefully consider the purchase and sale of assets in order to minimize their capital gains tax obligations, since investments account for a sizable amount of their income. When selling assets, businesses want to reduce the taxes they pay by taking advantage of favorable tax laws and market conditions. For this reason, timing is quite important. Furthermore, wealthy people frequently use sophisticated financial vehicles like venture capital funds, private equity, and hedge funds. These vehicles offer extra tax benefits, such deferred taxation on gains or favorable tax treatment for specific investment categories, in addition to high return potential, within the confines of the current tax laws. 5. Trusts and estate planning. Trusts and estate planning are essential parts of the wealthiest people's tax avoidance tactics. Rich people can minimize estate and gift taxes while also facilitating the transfer of assets to future generations through the establishment of trusts. Trusts are legal structures that hold and administer assets on behalf of named beneficiaries. They provide various tax planning benefits. First, by removing assets from the grantor's estate and lowering the estate's total taxable value, trusts may make it possible to reduce estate taxes. Furthermore, trusts can offer chances for tax-efficient wealth distribution, enabling the thoughtful distribution of assets to reduce tax obligations for both the giver and the beneficiary. Rich people can transmit and maintain their wealth while reducing the effect of gift and estate taxes on their financial legacies by using trusts and careful estate planning. 6. Tax loopholes and legal manipulations. High-income persons can strategically maximize their tax planning efforts by utilizing tax loopholes and legal manipulations. There are several features and loopholes in the complex tax code that can be taken advantage of to lower tax obligations. Affluent taxpayers frequently put together groups of knowledgeable experts, such as financial consultants, attorneys, and accountants, to manage these complexities and take advantage of opportunities. They might, for example, make use of carried interest provisions, which let some investment managers get paid at a lower capital gains tax rate on a portion of their income. In a similar vein, like kind trades offer chances to postpone paying capital gains taxes by trading comparable assets without resulting in immediate tax obligations. Rich people can further enhance their tax planning methods by taking advantage of specific tax treatment or incentives that may be available to certain businesses. High-income persons can efficiently reduce their tax liabilities while adhering to current tax regulations by employing legal strategies and tax loopholes. 7. Changes in family structure and income. Rich families use income shifting and family configurations as tactical strategies to maximize their tax advantages. Rich people can take advantage of reduced tax rates for some family members or make better use of their individual tax allowances by dividing their income strategically throughout the family. A popular tactic is to have family members work for family-owned companies, which permits business profits to be distributed to people in lower tax brackets. To further lessen the family's overall tax burden, income-producing assets might be transferred to family members who are subject to lower tax rates. Rich families can minimize taxes while following lawful tax planning strategies by using these measures to take advantage of the progressive nature of the tax system. To prevent possible scrutiny from tax authorities, families must make sure that their income-shifting strategies adhere to applicable tax rules and regulations. There is frequently discussion on the ethical implications of these tactics, as well as their effects on economic equality and societal justice, even though many of them are widely accepted and lawful. The intricacy of the tax system and the resources available to the wealthy allow them to keep one step ahead of governments that constantly alter tax rules and regulations to combat aggressive tax avoidance and evasion. The methods and tactics employed by the wealthy who avoid paying taxes shed light on a complex interplay between wealth, power, and the tax code. From sophisticated business structures to offshore accounts, these strategies offer a glimpse into a world where regulatory complexity coexists with financial savvy. While many of these tactics are legal and widely accepted, they often raise ethical concerns and prompt debates about economic equality and societal justice. Despite ongoing efforts by governments to combat aggressive tax avoidance and evasion, the ever-evolving nature of the tax system and the resources available to the wealthy enable them to stay one step ahead. Understanding how the rich navigate the tax landscape not only reveals the intricacies of tax planning, but also underscores the broader implications for our society and economy. As discussions continue, striking a balance between tax efficiency and ethical responsibility remains a central challenge in the ongoing debate over tax policy and wealth distribution. Thank you for joining us on this journey. Don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.